$312 a fortnight. That's what one couple lost from their age pension. Not because they did anything wrong, not because they hid anything from Centrelink, but because they misunderstood one number in the income test. They thought they knew how it worked. Turns out they knew the version that made sense to them, not the version Centrelink actually uses. By the end of this video, you'll know the difference, and you'll know exactly what to do about it. Hey, I'm Paul. Grab a cuppa, because this one is worth sitting down for. Here's what we're going to cover today. What the income test is actually designed to do, the specific misunderstanding that trips up thousands of retirees every single year, the few numbers you genuinely need to know, and then a worked example that makes the whole thing click. No jargon, no bureaucratic fog, just the real picture laid out plainly. So let's start with what the income test is supposed to do, because on the surface it sounds completely reasonable. The age pension is designed to support people who need it. So Centrelink looks at your income and says, the more you're earning from other sources, the less pension support you need from us. Simple enough. For every dollar of income you earn above a certain threshold, your pension reduces by a set amount. The idea is a gradual taper, not a cliff edge. You earn a bit more, you receive a bit less. Fair in principle. And that's exactly why most people think they've already got it figured out. They know they're allowed to earn something before it affects their pension. They know there's a threshold. They know it tapers off, so they feel across it. And honestly, that confidence is completely understandable because the basic concept really isn't complicated. But here's where it goes wrong. And this is the part that costs people money. Most people think the income test is about what actually lands in their bank account, the cash they receive, the dollars they can see. If I'm getting $800 a month from my super fund, they think, then $800 a month is what Centrelink counts. Logical, intuitive. And for some types of income, correct. But for account-based pensions, which is the most common way Australians draw income from their superannuation, Centrelink does not count what you actually withdraw, not even close. Instead, they apply something called deeming, and this is the word that makes people's eyes glaze over. But stay with me for one more minute, because once you see what it actually means, it's not complicated at all. Deeming means Centrelink assumes your financial assets are earning a set rate of return, regardless of what they're actually earning. They don't look at your statements. They don't ask what your fund returned last year. They take the value of your account-based pension, apply their own deemed rate to it, and count that figure as your income for pension purposes. Let that sit for a second. Your actual withdrawals don't matter to the income test. Your actual investment returns don't matter to the income test. What matters is the value of your account, multiplied by a rate that Centrelink sets themselves. And here's why that catches people out. If your account-based pension is worth $400,000, Centrelink deems a portion of that as income each fortnight. Whether you've touched the money or not, whether the market went up or down, whether you're drawing the minimum or nothing at all, the deemed income is assessed, and that deemed income flows straight into your income test calculation, affecting how much pension you receive. Now, the current deeming rates, and I want to be clear, these are the rates in place at the time of recording, so it's always worth confirming the current figures with Centrelink or a licensed financial advisor, because this is general information, not personal advice. The current rates are 0.25% on the first portion of your financial assets and 2.25% on anything above that threshold. For singles, the lower rate applies to the first $62,600. For couples, it's $103,800 combined. Everything above those figures gets the higher deeming rate applied. That might sound low, and right now, compared to what savings accounts are actually paying, it is relatively low. But here's the thing that matters. If your account-based pension has grown, if you've had a good few years of returns and the balance is sitting higher than you realise, your deemed income figure, is higher than you think. And that could be quietly reducing your pension without you ever noticing, because no one sends you a letter saying your deemed income went up when your account balance grew. The trap isn't in the rates themselves. The trap is in the assumption that what Centrelink counts looks anything like your bank statement. It doesn't. Those are two completely different numbers, and confusing them is exactly what catches careful retirees out. I've spoken to people who restructured their entire drawdown strategy, taking less from their super, spending more carefully, thinking it would protect their pension entitlement. But because the income test looks at the account balance, not the withdrawals, it made almost no difference at all. They were optimising the wrong number. So now you know the mechanism. But knowing the mechanism is only half of it. The real trap, the one that turns a general understanding into an actual dollar difference, is in how the numbers interact once you run them through a real scenario. Because here's what I want you to see next. The income test and the assets test run simultaneously. Centrelink applies both, and whichever one gives you the lower pension is the one they use. Which means there are situations where improving your income picture on paper actually makes your assets test position worse. That's not a technicality. That's the exact detail that determines whether a couple receives full pension, part pension, or nothing at all. And we're going to work through the numbers together right now. Let me introduce you to Margaret. She's 71, lives in regional Victoria, rents her home, and has an account-based pension worth $380,000. She also has $25,000 sitting in a savings account. She's single, and she genuinely believes her pension is calculated on the $28,000 a year she draws from her super fund. She's done the maths in her head. She feels across it. She's wrong. Here's what Centrelink actually does with Margaret's situation. First, they add up her financial assets. The $380,000 account-based pension plus the $25,000 savings account. That's $405,000 in total financial assets. Now they apply the deeming rates. The first $62,600 gets deemed at 0.25%. That's roughly $156 in deemed income. The remaining $342,400 gets deemed at 2.25%. That's around $7,704. Add those together, and Centrelink assesses Margaret as having approximately $7,860 in deemed income per year, or around $302 per fortnight. Now here's the number that matters next. The income-free area for a single pensioner is $212 per fortnight. Margaret's deemed income of $302 cites 90 above that free area. For every dollar over the threshold, the pension reduces by 50 cents. So 90 over the threshold means a 45 per fortnight reduction in her age pension. That's not catastrophic, but here's what Margaret thought. She thought Centrelink was looking at her $28,000 annual withdrawal, which works out to about $1,077 per fortnight. If that were the number in the income test, she'd have barely any pension at all. So when she first heard about deeming, she thought it was bad news. It wasn't. In her case, deeming actually works in her favour. But she didn't know that. She'd been too nervous to look, so she hadn't optimised anything. The common wrong assumption right here is this. People assume that drawing more money from their super fund increases their assessed income. It doesn't. Not for the income test. What increases her assessed income is the account balance going up. So if Margaret's fund had a strong year and grew to $420,000, her deemed income would increase, and her pension would quietly tick down, even if she hadn't touched the drawdown amount at all. That's the number she should be watching, not the withdrawal, the balance. Now, the assets test is running alongside all of this. For a single non-homeowner, the full pension assets threshold sits at $504,500, and the pension cuts out entirely at $945,250. At $405,000 in total assets, Margaret is comfortably within the full pension range on the assets test, so the income test is the binding constraint in her case. Centrelink uses whichever test produces the lower payment, and right now it's the income test doing the work. Run those two tests. Know which one is driving your outcome. That's the thing most people never actually check. So let's make this practical. There are 3 numbers that matter, and you can find all of them yourself. Number 1, the current value of all your financial assets. Not what you put in, not what you expect. The current balance today across your account-based pension, any super in accumulation phase, and any savings accounts or term deposits. Log in, check the statements, write it down. This is the number that feeds directly into your deemed income calculation. Number 2, your deemed income figure. Multiply the first $62,600 by 0.25%. Multiply anything above that by 2.25%, add them together, and divide by 26 to get your fortnightly assessed income. That number tells you exactly where you sit relative to the income-free area. I want to be clear here. These thresholds and deeming rates are the figures in place at the time of recording, and they do change. Always confirm the current rates with Centrelink directly or with a licensed financial advisor. This is general information, not personal financial advice, and your own situation will have details that change the picture. Number 3, the gap between your deemed income and the free area threshold. That gap, multiplied by 50 cents, is your pension reduction. Once you have that number, you're not guessing anymore. You're working with the actual figure, 3 numbers. About 20 minutes with a calculator and your most recent statements. That's what separates Margaret from most people in her situation. Now, here's the simple takeaway I want you to leave with. The income test is not looking at your bank account the way you think it is. It's looking at your asset values and applying its own arithmetic, which means the number worth watching isn't what you withdraw. It's what your accounts are worth, and the fix, when you need one, usually isn't about drawing less. It's about understanding which test is binding, knowing your 3 numbers, and making sure your account structure is actually optimized for your circumstances. That is completely doable. It doesn't require a law degree, it doesn't require sitting on hold to Centrelink for 3 hours, and it doesn't require being wealthy. It just requires knowing which number to look at. I hope this helped make the whole thing a bit less foggy. If you've got a question, maybe you're a bit like Margaret and you've been avoiding running the numbers, drop it in the comments. I read them all, and you're very rarely the only one wondering the same thing. If this kind of plain language pension walkthrough is useful to you, subscribe. I put out a new video every week. No jargon, no products to sell, just the numbers worked out plainly over a metaphorical cup of tea. I'll see you in the next one.